Welcome to today's Crystal webinar, Solution Found, Buy-to-Let and Residential, with Foundation Home Loans. I'm delighted today to be joined by Paula Priest, National Account Manager, and with today's webinar, our Q&A will be hosted by Dan Morris, Key Account Director at Crystal Specialist Finance. So my name is Chris Corns and I'm the Operations Director here at Crystal Specialist Finance, and I'm here to talk to you a little bit about what Crystal Specialist Finance can do for you. So stay tuned for the live Q&A at the end of the video. Please ask questions during the webinar. There's a Q&A button that you should see at the bottom of the screen. Pop your questions on there and we will do our best to get those addressed for you at the end of today's session. So firstly, a little bit about us. We are Crystal Specialist Finance and we do exactly that. We specialise in specialist finance. So for us that means bridging, buy-to-let, commercial, development, second charges and complex residential. And as you can see there, we are dedicated to the intermediary. Service is our obsession. We are a multi-award winning business and we've been in business now for over 40 years. We deal with over 80 lenders, 200 years combined experience within the team. And there's just a few of our awards there on screen from last year that you can see. But something that's really important to us, as well as winning awards and completing business, is health and well-being in the intermediary sector. So we are launching a campaign of promoting awareness of mental health and well-being in the sector. We're working in cooperation with leading mental health charity Mind. And again, throughout the course of this year, as we did last year, we're going to be giving you hints and tips, guidance, resources and information from mentors within the industry on looking after your own and your colleagues, your family's mental health. It's something that's really important, something that we're really passionate about. So on the screen, you can see a QR code. Feel free to scan that or visit crystalsf.com/wellbeing, where our latest broker survey is there. We're collecting information now that we'll be reporting out shortly, and that will enable us to shape the rest of the year and the events that we deliver to you on that front. So please do take some time to complete that. It would be really appreciated. Last year was a very difficult year for many different reasons. But today we're going to look at the changes that have happened to the buy-to-let landscape. We'll start off with a little bit of history prior to last year, and then we'll look at specifically what last year's done and why it's so important that we all work together to get these solutions in place for your clients. So back in 2016, the 3% surcharge on second property purchases came in, and the introduction of consumer buy-to-let. We then saw 2017, the stress test changes by the PRA and tightening of lending criteria. 2018, we then had EPC standards, we had extension of HMO licensing, minimum bedrooms and property sizes. And then 2020, the tax changes kicked in where landlords are now no longer able to deduct any mortgage interest from their rental income. So all of that was planned prior to COVID. Then the COVID impact. August 2020 saw lenders not able to start eviction proceedings until they've given 6 months' notice. This has been removed and can now be pursued through the courts. However, the courts are prioritising cases. There's talk now of Nightingale courts popping up across the country to try and speed up some of these processes. So we've had an example where we've spoken to a landlord that had to spend £35,000 to try and evict a problem tenant, and the rent was only £500 a month that was coming in from the property. So it can be very difficult. Legislation is now in place to ensure bailiffs don't serve eviction notices until May, unless it's a serious case. There were payment holidays granted from lenders, so how they will impact people's credit reports and their borrowing moving forward is still something that we're yet to see. Tenants were also granted rent payment holidays, which again put pressure on landlords. And of course, for the smaller landlords, you've then got the furlough situation where people's personal income might have dropped, which again can impact on borrowing, especially if people are still furloughed, with the extension of that scheme now running for a few more months yet. So it's a very difficult environment to trade through for most businesses, but again the buy-to-let landlord seems to have been hit very hard on legislation changes and regulatory changes prior to all of this happening, so this just exacerbated problems that were there already. However, landlords are an optimistic bunch and a lot of them saw the COVID-19 pandemic as an opportunity. So the number of landlords looking to increase the number of properties they own has jumped by 71%. Now, 19% of landlords intend to increase their portfolios over the next 12 months. This is up from 12% in April 2019. And again, a third of landlords saw it as a problem. It made no difference to the investment plans of over half of the investors that we're dealing with. But again, we'll look in a few slides' time, we'll look at some of the opportunities that this creates, but they are an entrepreneurial bunch, so they will look for opportunities where they lie. And there could potentially be a difficulty over HMOs. Investors are still keen, lenders are still willing. However, there is a little bit more due diligence that needs to take place. Student lets, for example, how is the demand impacted on student accommodation with more and more courses going online? And again, given the difficulties of the current situation alongside social distancing, rule of six, will demand still be there for tenants wanting to take HMO properties? Now, there are lenders that will still look at these cases, but they do ask more questions now than they were asking before, just to ensure that it's something that has been thought about, let alone the boom in HMOs we saw a couple of years ago where properties were being converted left, right and centre. So it's something that can be done, just needs a little bit more thought when you're talking to your landlord clients. Another impact that COVID had was slowing down the application process. So what can we do to make sure cases go quicker? Lenders' turnaround times are what they are. If they're inundated with cases, there's only a certain amount of hours in the day to get that done. But there are certain things that we can do to get that expedited and to get our cases looked at quicker. So let's ensure that the information is provided in full at the start of the transaction. Let's make sure we're managing expectations with the clients. It's pointless everyone saying it'll be looked at in 24 hours if we all know it will be 5 days. So again, it's making sure that we're honest and transparent about these timescales. Ask the client as many questions as you need to obtain their ID documents and other materials at the start. It's no different from a normal mortgage transaction. You still need to provide proof of ID, proof of residency, generally proof of income is required. So let's make sure we're boxing that off nice and early. And then when further information is requested, let's be very quick to get that information and put it on file. The amount of cases we've seen stalling because we're waiting for one document, even on the day of completion, we're waiting for one document to come in that we've been chasing for weeks and weeks. So let's make sure we're on top of that and we are getting documents in as quick as possible. It's like the tennis match, isn't it? Let's get it out of our half of the court as quick as we can and back over the net into the lenders to get them dealing with it, or the solicitors. The other element, common reasons deals change, is after a case has come into us, the process of investigation reveals further information. And there could be many reasons for that. It could be that the searches have revealed information not previously provided by the client. It could be that the current markets are moving much quicker than they were previously, so lenders are having much smaller lifespans. There was an article from 27 Tech yesterday where they were talking about their systems and saying that they're now getting inundated with lenders saying changes in effect, changes coming through from immediate effect, rather than it being this will happen on Monday or Tuesday or something. It's happening now. And that's because risk models are being constantly reviewed, property prices and valuations fluctuate, and that's both ways. It's lenders dipping their toe back in the water or thinking that things are better than they first thought, so they're extending their criteria, as well as lenders retracting if they're too high LTV or they're exposed in certain areas that they don't want to be. So the key is in the knowledge of as much information as you can, disclose as much as you can, as early as you can, and it means the cases move through much more smoothly. So today we're talking about solutions in the complex buy-to-let space and the residential space. So first of all, complex buy-to-let, simply cases that fall outside of the mainstream high street remit. And I know Paula and Keith will talk shortly about some of the specific USPs of Foundation, but it's things like non-standard construction properties, complex income sources, limited companies, SPVs, things that fall outside of the high street is where we pick up a lot of business. And we've placed almost every type of scenario you can think of, and we've done this for years and years. We've approached this from a commercial angle rather than from the residential angle. So for us, a limited company with 2 new directors buying a multi-unit block, it's a run-of-the-mill transaction. Whereas for others, if you do residential day in, day out, it could look quite a complex scenario. So for complex, we're looking at things like first-time landlords, low personal income, elderly applicants, consumer buy-to-let, etc. And there's the range of rates that are available in the marketplace. So straightforward cases, complex cases, and then very complex at the top end. So you can see there's a wide fluctuation in rates, but that reflects the risk and the circumstances of your individual clients. A study carried out a little bit of time ago now, 2018, showed that of an average mortgage broker's cases, almost half of them could be classed as complex through self-employment, adverse credit, debt consolidation, etc. So it is the kind of business that you would be coming across regularly in your day-to-day transaction types. And it's mainly because customers these days have more diverse needs, and this is both in residential and commercial. So if you're not considering specialist finance as a major part of your product offering, then you could really be missing out on both assisting your clients and on the commission that brings back. So if you start looking at things like adverse credit, CCJs, complex income, self-employment or contract work, clients that are lacking in experience, expats, foreign nationals, or clients close to retirement age, you might find the lending landscape looking very barren from a mainstream point of view. However, Crystal can help in all of those scenarios. It's all about knowing who to turn to, when to turn to them, and what you need to achieve. And that's where we really stand apart. Now, here's a couple of case studies of recent cases that we've completed that can hopefully bring this to life a little bit more. So we were approached by a new build broker looking to place a case for an expat client. Now, the client was a teacher in Australia, had been there for a number of years and wanted to take advantage of an opportunity. The property was in the Midlands. They knew the area well from previous family visits, but they were attracted by the yield, attracted by the quality of the property, and they thought this could be a good return for them. So there's a number of things there that fell outside of the mainstream environment. However, as you can see there, we placed the case 75% loan to value, 3.79 on a fixed rate buy to let. And with the rental yields that are coming back from that property, that was a really good transaction for the client. And here's a case that completed this month, or a series of cases that completed this month. Borrower with multiple properties owned in a limited company wanted to capital raise on a bunch of them in order to purchase more. So they were all Nottingham based, all ranged in value from 45 to 125, ranging from 1-bed flats up to 3-bed flats and masonettes. Some were multi-unit blocks where the client owned the upper and lower flat. Again, some ex-local authority, there were some new builds, very mixed portfolio of properties, with some currently undergoing splitting of the titles. So on this one, we arranged 7 individual buy-to-lets across 3 lenders, ranging from 70 to 75% on each property in order to get the very maximum to suit both the client and that lender's appetite. And the rates there from 3.69 up to 4.3. So again, I'm sure you'll agree, they're not too different to what the client would be expecting from the mainstream market. But again, factors pushing it away from the mainstream doesn't necessarily mean it's going to become an expensive loan. It just means that it might need a more specialist lender, a more specialist approach in order to get that done. So working with Crystal is really straightforward. The key thing that we need initially is to see the deal. We need a conversation with you to understand what it is your client's looking for. And there's numerous ways you can do that. You can just send us the details on email. You can go to our website and use our new hub, where you can go through a broker journey and book some time there with an underwriter to discuss your specific case. You can ring us. You can visit the premises here in Tamworth, obviously socially distanced, and keep in touch with us on a number of our events like this. We also do live appointments with BDMs, etc. So any way that suits you, the key thing for us is having that initial inquiry conversation where we can understand really what it is you're looking to achieve. So our new business team then take that information and then they will source the most competitive and relevant product and issue terms to you. We'll also then have a discussion with you at that point to really understand whether that suits your client's requirements. We can talk through the detail of the quote. You can then discuss that with your client and decide how to move forward. If everyone's happy, complete the application, send that in to us, and then our processing team will handle the rest of the application, keeping you informed all the way through. At that point, you can become as involved or as uninvolved as you want to. You can either refer us the client and we'll see that through from start to finish, or you can be involved all the way through and provide us the documentation that we need, working with your client in order to get the requirements that the lender needs. We're happy either way, dependent on either your preference or your network's preference, whichever it is. Again, we'll deal with either of those for you. And again, what sets us apart from some of our peers is that we don't stop work at offer. So as soon as the case is offered, that's when a lot of the work starts for us, because we will then liaise with the solicitors on both sides in order to satisfy what could be quite complicated legal requirements in order to move that case forward to completion. So for us, our job isn't done until that money is released and with the client in order to get either the property purchased or remortgaged, wherever it will be. So we've got a team of dedicated case managers here at Crystal that will be walking you through that process every step of the way. So if you have any questions, please pick up the phone, give us a call, and let's have a chat through. So a very quick presentation from me there today, so thank you for that. Stay tuned for the live Q&A at the end of the video, and again, I will reiterate, please don't forget to ask your questions using the buttons below, and we will get them all addressed for you. Our contact details are on the screen at the moment, and I know my colleague Dan will be picking that up at the end of the call as well. So for me, thank you, and it's my pleasure now to hand you over to Paula Priest, National Account Manager at Foundation Home Loans. Over to you, Paula.
So, a very good morning to you. My name's Paula Priest and I'm National Account Manager at Foundation Home Loans. I'd just like to say a massive thank you to Crystal Specialist Lending. We've got a really close relationship with these guys and we work really close with them. They've got their own dedicated business development manager and they've also got their dedicated underwriters and they know our criteria and inside and out. So it's like having another special lending arm. So massive thank you to you guys. So I'm just going to share my presentation with you and we will get cracking if that's okay. So we'll get cracking without further ado and I'll look forward to speaking to you about any questions that you've got moving forward. So what are we going to be discussing with you today? Well, I thought we're going to make it as insightful for you and give you as much detail and add as much value as we possibly can. In order to do that, I thought I would share with you some data that we've obtained. We're one of a number of lenders that actually subscribe to a company called BDRC, and I'm going to be sharing some research that they've done with the National Landlords Association. They interview a large number of landlords every quarter, so I'll share with you some of that data. I'm also going to be able to discuss with you how Foundation Home Loans can help you with buy-to-let solutions, obviously working with Crystal moving forward, and how we can help you with your cases that are currently falling off the high street for a number of reasons that we'll discuss moving on. So first of all then, for those of you who haven't heard about Foundation Home Loans, we have been trading for absolute years, but we rebranded in 2015 as Foundation Home Loans. The great news is that we are pro-intermediary. We only work through clubs, networks and our packaging partners, so your customers can't access our products or services directly with us. We've seen, we're a lender that securitises and we've seen 4 successful securitisations. We've got another one coming up and we've got £1 billion worth of funds sitting in warehouse facilities. So that just gives you some idea of the sort of scale that we have and you know, the fact that we are here for the longevity, if you like. There are plenty of funds to lend. I know that is a question that quite often comes up with brokers when they're not used to dealing with specific lenders. We focused as a lender predominantly on limited company buy-to-let, short-term lets, HMOs, multi-unit blocks, and it's a market that we've become really well known for. However, we are now in the residential market, and as Crystal know, and we are helping them help a lot of their clients with the cases that are falling off the high street for a number of reasons. So let's have a look at some of this research then and see what's been going on. The research that I'm going to be sharing with you is up to Q4 of last year. We are due to have another one, obviously because the first quarter of the year has just come about. So we will be doing further presentations, obviously, on the latest data coming up. So let's have a look at the portfolio market then. In Q4, the typical portfolio was worth £1.3 million and generated a gross rental income of £55,000. Based on averages, that equates to about 7.8 properties per portfolio landlord, with the average value of £163,000, generating annual income of £7,050 or £588 on a monthly basis. So you can just start thinking about your areas and how that compares with the average. 60% of landlords fund part of their buy-to-let portfolio through buy-to-let borrowing, so lots of opportunities for us all there. And they hold an average of 4.9 loans each. 40% of these landlords are unencumbered, so they haven't got any mortgages, and 26% are partly unencumbered and partly buy-to-let mortgages, but 33% only own their buy-to-lets on a buy-to-let mortgage. So that just gives you some idea of the opportunity that is there. If we have a look regionally at the typical portfolio values and gross rental income sort of moving forward, central London and out of London have been really hard hit, with 89% saying, this is 89% of those London landlords, if you like, saying that it's negatively impacted their lettings business. 81% of these saying that the income that they can generate has reduced quite significantly, and 55% saying that tenant demand is falling, and a staggering 38% of those central London landlords are saying that they're planning to divest or sell their properties, if you like. Why is that? Well, we've seen so many companies that have said now that, you know, they've had their workers working from home for the last 12 months. Why do they need to be renting out expensive properties in London? And of course, those employees saying, well, if I can work from home moving forward, why would I be paying, you know, excessive rent in London when I can move way out to the outskirts and obviously be paying a lot less in rental income? And that's what's happened. The demand and the need to live in central London because of work has obviously reduced, and those landlords have been quite significantly hit. If we have a look at the effect of COVID on the mortgage industry in general, about 16% of overall mortgage holders took a mortgage payment holiday. And of those, 8% of buy-to-let landlords took a mortgage payment holiday, and that was whether they needed it or not. You know, they took a mortgage payment holiday. If we have a look at this graph, the light yellow line at the top shows the percentage of landlords that are making a profitable full-time living from letting their property. Since the end of 2017, this equates to at least 30% thereabouts of landlords. The dark yellow line that you can see shows the landlords in excess of 50% that have supplemented their income since 2015 with letting income. So these have both got self-employed or employed occupations and are supplementing their income. And then the percentage of landlords making a loss is at the bottom, and that shows the ones that are basically, I think they're probably like I was actually, a dinner party landlord, had one property, 40% taxpayer, and decided, you know what, this is a lot of work, and by the way, with the changes, it's just not worth it. So those people, and they've obviously kept the properties or will be looking at moving. And what we've seen, especially with the stamp duty incentives, is a lot of those maybe dinner party landlords have come to Foundation Home Loans. A lot of them have come to us through Crystal because they've looked at changing their business from personal buy-to-lets to limited company buy-to-lets to take advantage of that stamp duty situation. So let's have a look at the market overall from the good old heydays of 2007 to the current day. Well, if we go back to 2007, there was about 65% of landlords that had net profitability. But if we have a look, and even throughout COVID, we've seen that the average landlord has been getting about 80%. So 80% profitability with landlords. And that's just carried on. So this is a really strong market, guys, and it's not one that's going to be going anywhere anytime soon. And we can see that from the profitability trends. If we have a look at average rental yields, they've remained stable at 5.8%, which was up about 0.1 from Q3 of last year. Yorkshire, the Humber and the East Midlands are enjoying the highest rental yields at about 6.4%, with London and sadly the West Midlands, as you can probably tell from the dodgy accent where I'm from, the lowest, about 5.1%. So that just gives you some idea of what the rental yields have been throughout the UK. I know something that Chris was speaking about earlier, HMOs. We're seeing about 1 in 5 applications coming into us on a HMO basis, and so many inquiries from first-time landlords, and I'll discuss that a bit more detail when I look at how we can help you. And it's hardly surprising because HMOs enjoy the highest rental yields, and lots of landlords are diversified into this area because the yields are on average about 7% in comparison with maybe detached houses, which are the lowest at 5.1%. However, the highest rental yields are coming from tenants that are migrant workers, local housing associations, universal credit claimants, and the lowest are coming from company executives, younger couples and older couples, which is strange because you would have thought that would have been maybe the other way around. So that was one of the stats that was quite surprising to me. So if you're looking at, you know, the type of tenants and the rental yields that are got from those tenants, quite interesting to have a look at that. So moving forward, absolutely really positive and great news, especially for us in the mortgage industry, is 32% of landlords are now reporting the highest increase in tenant demand, almost the highest proportion in 5 years. So lots of opportunity. Why is this? Well, let's face it, we've all been living under the same roofs for the last 12 months. You've got parents that are deciding that their adult children can sling the hook. They've had enough of them now, living in the same four walls. Probably some of those adult kids thinking, do you know what? Time to get my own place. And we've had couples, relationships, partnerships breaking up because we have been within those four walls. So the highest demand within 5 years, and hopefully that will carry on continuing and the market will carry on increasing. If we have a look at, you know, the optimism in the market, IMLA are actually predicting that we're going to do about 283 billion this year. I think we did 240 billion in lending as a market in 2020. And obviously we hope that we're going to be seeing increases in that within the buy-to-let market. And we'll have a look at some stats with you shortly. 27% of all those BDRC landlords, those landlords that they interviewed, are planning on remortgaging this year. So again, lots of opportunity. If we have a look, going back to 2007, when we were doing about 46 billion in buy-to-let lending, that is actually saying, and the graph, the predictions are that hopefully we will be going back into the early 40s, again, early 40 billion pounds worth of lending in the buy-to-let market. And long may it last, I hope anyway. So how can Foundation help you? Well, lots of people come to us because, first of all, we have no minimum income. However, your clients do need to have an income, and that's really important, specifically to cover rental voids. Prior to the pandemic, the average property was empty for about 72 days, and that's increased to about 87 days throughout the pandemic. So it is really important that your clients receive an income to cover those rental voids or have savings to be able to do that, especially when a number of lenders now have declarations for customers, landlords to sign to say that they won't be completing on a mortgage and then going on a mortgage payment holiday, specifically lenders like us that securitise, because that causes major problems when we look to securitise that loan. We also have no minimum time in employment or self-employment. They just need to be able to evidence employment or self-employment. The great news with Foundation is that we don't have any maximum age for limited companies. So this is a great tool for a lot of your landlords to use for inheritance tax planning. Theoretically, you can apply as a director for a mortgage at the age of 85 for 30 years. So it's not a let to die mortgage. You can actually have up to 4 directors on an application and unlimited shareholders. And where this really comes into its own with inheritance tax planning is you can have children on the application over the age of 18, but have a shareholding of 19% or under, and they don't form any part of the application process, and there is no credit scoring on them. Crystal can also help you through us with your expats limited company. So any limited company expats that you've got, providing that they've already got a buy-to-let mortgage within the UK, and that we can trace them on basically they've got 3 years bank statements that we can trace them for. And if they are portfolio landlords, that they do declare their income for UK tax purposes. So any questions that you've got on any of those, please make sure that you are speaking to Crystal. And then looking at portfolio landlords, this is an area that we're seeing growing and growing and growing. Currently with Foundation, we have a limit for background portfolios of £3 million. However, if you speak to Crystal about any good portfolio cases that you've got that exceed this, they will happily discuss and present a business case to us for even going up to maybe £8 million for the right case. The standard will do portfolios for 3, and then through Crystal, if we can negotiate and look at the case and, you know, put together a good business plan where we can present that to our CEO and board, then we can look at that with Crystal as well. We don't ask for business plans or asset and liability statements from your landlords, so we don't make it hard for them to do business with us. And let's face it, most landlords will only get those done for mortgage purposes anyway. And we'll look, if you've got landlords that have got over 10 properties in their property schedule, then you just send us the spreadsheet through Crystal and we'll key those on for you. The great thing about landlords, and the reason that Crystal do actually use us quite a bit, is that once we've assessed and underwritten the first case in a portfolio, the landlords can then add to that portfolio within the next 6 months without any further underwriting. So that tends to win us quite a few brokers that, you know, are looking either to remortgage a number of properties in quick succession or are planning on buying new properties quite quickly as well. We also consider as an income, a minimum income, portfolio income as an income in its own right. So they don't need to have an employed or self-employed job as well as their portfolio income. So if that's all they do, they're just portfolio landlords and that is their income, we can consider that. Also, as Crystal know, if they've done a bridge to help you or to help one of your landlords to buy a property, we can consider a day one remortgage as an exit off a bridge. So if you've got any of those cases, please let Crystal know. If it is a day one case, we will go on the current valuation. However, if they've done work to it and it's 6 months later, we will go off the market valuation. Again, Crystal will be able to help you in discussing those scenarios. As we mentioned, when we were looking at the stats, HMOs have become more and more popular and hardly surprising, with rental yields up to 7%. And we can help you with HMOs up to 8 bedrooms and multi-unit blocks up to 10 units under 1 freehold. Again, there is a bit of flexibility on that. You will need to speak to Crystal about any cases in excess of that, and they can negotiate with us. And the rates are the same, but they can just negotiate whether or not we can do it on a case-by-case basis. The great news about Foundation is that we don't require HMO or multi-unit block experience. We only require that they've rented out a property for 1 month. And the good thing is that if you have got any first-time landlords that are buying these properties, and we're getting loads of inquiries, if they've been bought on a bridge, we can then look at remortgaging them over to us after 1 month's experience. Or if Crystal think, look, this is a really solid case, you've got, you know, 4 directors looking at buying a HMO or multi-unit block, they haven't got any experience in renting out a property, however, they're professionals, they're all enjoying really good income, so, you know, rental voids aren't going to be a problem, then Crystal will actually speak to us, their BDM Keith Jones and their underwriters that specifically deal with their cases, and they can negotiate to whether we can do that on your behalf for you. Short-term lets, we saw a lot of lenders drop out of this market during COVID. The reasons being that obviously a lot of these properties, you know, nobody could go to them, could they? So it was a sensible move to drop out. Foundation, we came back into the market very quickly. A lot of lenders have just decided, you know, to stay out, but there are a few of us, including some of the smaller building societies, that are still in the short-term let market. If you've got any of these cases, please speak to Crystal, who know exactly how we deal with these. Just to give you a few sort of hints and tips, we basically look at the rental on an AST basis. So we don't look at what the property will achieve. It is looked at on an AST basis. It can't have any restrictions to sale. So it can't be in a holiday home complex where it can only be used for letting. It has to be able to, you know, obviously be let on a standard AST. And we're also doing student lets as well. And Crystal can help you with all your student let requirements if you are concerned or you've got any applicants that are looking for those. So that just covers off how we can help you at Foundation with our buy-to-let proposition. So I'm going to discuss briefly with you now how we can help you with residential, and then we'll go on with Dan to the Q&A session. So we have seen so many lenders in the market that have tightened their criteria and credit scores, specifically with self-employed people that might have been looking at capital raising to pay off credit cards or debts that they've incurred through COVID. This is just amazing, because I've worked in the mortgage industry for 31 years now, and banks, building societies, and latterly specialist lenders. And some of the cases that I'm seeing dropping off are unbelievable, and you would have expected that we would have been able to help you with at any time. But unfortunately, they have dropped off the market. So what I thought I'd do is just giving you an insight of how Crystal and Foundation can help you with those cases. So first of all, we can help you with complex income and your complex employment cases. Complex income is income from multiple sources. So it can be retirement income, investment, trust income, benefits, rental income, overtime and commission. It could be a number of these incomes. And in most cases, if they have got a number, there's too many ingredients for the cake on the high street. The computer can't make any assessments. It's not manual underwriting in many cases, so they decline it because it's too complex for them. Luckily, we are one of the lenders that does manually underwrite and can look at a case on a case-by-case basis. So that's your complex incomes, whereas your complex employment is where someone's income is anything other than one straightforward job. So it could be they're self-employed and they've also got a combination of PAYE, or they're PAYE and they've got a number of employers and they need to use most of those incomes, or there might be short-term self-employed people or contract workers. In fact, they might have both complex income and complex employment, making it even harder to obtain a mortgage on a high street. However, these people might be people that, you know, you would be thinking, if I was a lender, I would lend my own money to them. You know, it's that safe. That's the sort of area we are. So if it is just dropping off the high street, speak to Crystal, because they've got a panel of lenders that they can look at referring you to as soon as it does. And with rates starting at 2.89 if you don't want ERCs, or we've also got a 2-year 2.89 fixed product, then they're hardly what you would have thought of as subprime rates, and we aren't a subprime lender. For example, and I will actually just show you this, we have got a criteria grid that sits on our website, and that just tells you the basic. Crystal can obviously tell you in a lot more detail all the nuances and how we can help you, but they can't have had any mortgage arrears in the last 3 years, and any CCJs or defaults must have been paid off before application in full. So we're a high street, just off the high street lender, and Crystal will be able to help you with any of those cases. So how can we help? in specific areas, well, we can help you with the self-employed, sole traders, or directors that own more than a 20% of a share we class as self-employed, and specifically those that might have been trading within the same industry but might only have 1 year's accounts, so we can help you with those. Employed to recently self-employed with no minimum time, people that are newly employed in probationary periods. We'll look at, well, what area are they working in at the moment? How far into their probationary are they? And what's the experience in that role? So we will have a look at those cases for you. People that are looking at 100% of bonus, overtime, commission, and we'll look at sustainability. For example, if you've got somebody who is a car salesman, they might have been earning £70,000 in the past, but their basic was only 15,000. So they haven't been able to earn any money, but they're going back to work now. So when they are back at work and they might be struggling because the P60 is going to say a lot less, if we can show that historically they've earned that income and there is sustainability there, we will look at the case on a whole. So any cases like that, speak to Crystal and they will know our parameters and how we can work with you guys on those cases. We've already mentioned multiple incomes, multiple employments, getting turned down off the high street because the computer can't say yes and make a judgment on those. Unusual incomes, so many unusual incomes that we can help you with. You know, it could be contractors, fixed term contractors or contractors using umbrella companies. People, as long as they've got 3 months remaining on the contract, that we're able to help you with those. Looking at some of the unusual incomes, we'll look on another slide, but I'll move forward anyway, because I know that we are getting to the end of the presentation and I want to make sure that we are giving you plenty of time to ask any questions. So looking at some of our criteria, minimum property value 75,000. We can help you with all your debt consolidation up to 85%. And the great thing about us is that we've got no maximum debt to income ratio. So theoretically, you can have an income of 30,000 and you can have debts of 40,000, the debts exceeding the income, and we can still help you as long as it fits affordability. Great news for any customers that are looking at interest-only mortgages. We will do interest-only up to 70% loan to value. And guess what? We actually calculate interest-only on our calculator as interest-only and not on a repayment basis, as strangely many of our competitors and the high street do, which makes it a lot more affordable. If you are struggling with affordability, again, Crystal can help you with that. If they are looking at part repayment and part interest only, we can do up to 80%. We'll look at all the standard repayment vehicles. If they're looking at sale of property, for example, we will go up to £150,000 in equity they must have outside of London and the southeast, or 200 in London and the southeast. But you know, if you've got people that are really struggling at the moment, and we had a guy that came to us through Crystal, and they'd got he just gone from being employed to self-employed through his company because he was made a shareholder, and they've got a lot of equity in their property, but they'd got 2 kids going to private education and they wanted to switch to interest only for a short period of time. Those are typically some of the good cases that we are looking at helping people. And we'll look at like endowment policies, regular savings, cash ISAs, investments. We'll look at 80% of the current value of investments plus stocks and shares, etc. I won't go into that. Bank nurses, you know, will help you with all of those. We'll look at retained profits, obviously accountable to that specific year. Up to 4 applicants go on applications, but we'll only go up to 80%, but we will use all their incomes. Gifted deposits from family, we accept gifted deposit overseas as long as we can show evidence, obviously, for money laundering. Developer deposits at 5% and 100% of family deposits if they would like that. We'll deal with your EEA foreign nationals and your non-EEA foreign nationals, as long as they've got 25% deposit and we're able to trace them legally in the UK with a bank account for 3 years. A question I get asked quite a lot is, can you do a remortgage for a married couple in the sole name or a purchase? The answer to that is, if the current mortgage is in the sole name, or the remortgage is, you know, from the sole name to the sole name, then that is fine with us. We wouldn't be looking at doing a new application for first-time buyers in a sole name, or just to get somebody off the application because they have got debt. I've discussed a lot of the complex incomes, and if anybody's got any questions on any of the incomes, then I'll happily discuss those with you to Dan. And that is basically what we can help you with, and how Crystal help us to place mortgages in a nutshell. So I'm going to invite Dan Morris back. Dan, if you're there, Key Account Director of Crystal, it will be good to have you back on the screen. I hope everybody found that useful, and if you've got any questions, fire away and we'll see if we can answer them.
That's it. Thank you very much, Paula. That was a very insightful session, as was Chris's. So hopefully everybody got as much out of that as possible. Very, very useful for me. So I learned quite a bit that I didn't already know about Foundation. Obviously, you are a fantastic partner to work with, a great lender, common sense approach, and you'll do a lot of stuff. And we've really built a great relationship with you over the past couple of years. And again, it's just getting stronger and stronger. So for me, thank you for your support.
As well, Keith, I know that I mean, some of the cases that you've put to him and the solutions that he's been able to find for you by working with you guys have been absolutely amazing.
That's it. It's just having a great working partnership and likable people to work with, and more importantly, great products and a kind of yes attitude rather than no, or creating problems for cases, which is kind of why everyone's on this webinar, really, just to find solutions and not find problems or barriers. So,
and absolutely, and by speaking to yourselves, Dan, and obviously running the case through you and you speaking to Keith, we can get a good barometer before you even put that dip in. And before Crystal actually dips the case, you've got a really good idea through Keith and our underwriters of, you know, the chances of that case being successful at the end of the day, which is what we all want to achieve for our customers.
Exactly that. Perfect. Right, let's get into some questions, because I know we've got a few questions that have came in already. So thank you everybody who has put some questions through. I'll try and answer as many of them as possible live. So let's see what's came in first. Right, which one? Eeny, meeny. Right, okay. So first one, are you able to offer remortgages for capital raisings for home improvements with clients who are in an active debt management plan?
Unfortunately, we're not. We are, as I said, we are just off the high street. CCJ's defaults, they must have been fully paid off, and any debt management plans also have to be fully paid off. But I know that there is another couple of lenders that you'll be using quite closely after us when it falls off the high street that can. But yeah, that and payday loans. Unfortunately, no payday loans within the last 12 months, and unfortunately no debt management plans. And a lot of these debt management plans, the brokers don't even realise they're debt management plans when they come in, because they disguise themselves as a loan. So it's really important, and I know this is one of the things you work with, Dan, with a lot of your brokers, is to just check out the loan company, because a lot of these have just taken on the debts from debt management plans.
Yeah, no, exactly that. I mean, it's about understanding and being able to read your credit report, which I know a lot of people do still struggle with, because it can be quite complex, quite hard, especially if you've been given one as to a firm that you're not used to dealing with. So you might be used to Equifax, you get given an Experian, a Clear Score, whatever, and you're unsure about that. So again, it's just asking the question to us. But from me, yes, you can't do it, but there are lenders out there that will consider it. So there's different sets of criteria. So you may have to have been in it for 12 months and have decent conduct. It may have had to be because of a life event, which has caused you to go into debt management plan, which is, I suppose, a legitimate reason, rather than just being wild and carefree and been to Vegas and put it all on black and unfortunately lost. And then some lenders as well will ask you to, if they're wanting to capital raise, that you'll need to capital raise to repay the debt management plan first, rather than spending money on something else, which you shouldn't be. Let's be honest, you should be clearing the debt first from a lender's point of view, responsible point of view, getting rid of that debt management plan which you've got yourself into, and then looking to do your home improvements as such. But what I would say is, speak to us, let's have a look at the case, and we'll see if we can find a solution for it, because there are solutions available. However, obviously they're not going to be high street or near high street. You're going to be further down the line to your subprime lenders. But anything's possible with ourselves in this market. Next question to come in, Paul, this could be one for you. I have a limited company case to place. There is only one director who is a 60% shareholder. Is that acceptable, as it's been declined by another lender who requires 80%?
Right. So the one director is a 60% shareholder, and then there's obviously other other shareholders on the application as well.
Yes.
Yeah, absolutely. If that's the format that they want it, absolutely. Yeah, we can have from one director up to 4 directors and unlimited shareholders over the age of 18, and shareholders don't form part of the application if under 19%. So, they wouldn't have to declare themselves on the application. They wouldn't have to go through any credit scores. Once they get over, so 20% or above, then obviously we need to credit check them, and they do need to form part of the application. And it's worth mentioning at this stage as well that we do ask for personal guarantees, like a lot of lenders, Dan. With any of our mortgages for directors. So personal guarantees are required by any directors of the application.
Perfect. No, do you know what? That's a brilliant question. That you got the answer you wanted, so get the case sent in, please. Yes, we're more than happy to look at that. Another great question. Would you consider a remortgage on a barn conversion without the usual 10-year warranty in place? It was converted in 2012, and I'm looking to cap raise for an extension, and it's currently unencumbered.
Has it got any guarantees like BOPUS, or has it got any, or just no guarantees at all?
Dave, if you could let us know that, please, and we'll get back to you on that question.
If it's got no guarantees, then as a lender that securitises, we would struggle to securitise that loan purely on the basis that if anything goes wrong, obviously, how are we going to be able to sell it? And because all our books are audited, obviously, before they securitise, that would cause us problems. But it could be that they have other guarantees rather than NHBC. So let us know, and we'll see if we can take that forward. I had one actually, which is something that I don't know if you probably know more about this than I do, Dan. We've recently had a case. It was non-standard construction, one that I would have said no to straight away and told the broker to speak to yourselves. It was like a flat roof, really modern property built in 2012, but it was all wood fascias on there. So I would have said no. We got the normal, well, let's see what the valuer says, which we know where that goes, don't we, Dan?
Yeah.
And of course it come in, we ended up having to decline it because the reason is they wanted this BOPUS. You probably know more about that than I do as a specialist lender report, because after 2012, 2013, there was other requirements. So the fact that they only had the NHBC and guarantees didn't make any difference because of when it was. If it had been a recent one, then it would have been great. But so it's always worth checking out with people like yourselves, because that's something, I mean, apart from experience telling me as soon as I saw the property, why have we even considered this?
Yeah.
Then I wouldn't have known that, anything about this 2012 and BOPUS and, what the new regulations were.
Oh, that's it. I mean, I've learned so much in terms of construction types and actual stuff that I didn't think was possible. But again, what I would say about the specialist market is majority of things can be achieved, but rate reflects the risks. So if you've got something like that where ultimately there's no warranty in place and it has absolutely nothing as such, it could potentially be achieved, but you might be looking at a really high rate, because again, you are taking a huge risk on this client and this property type as such. So it's always worth asking the question.
We've got to look at resaleability, haven't we, at the end of the day, Dan?
That's it.
How resaleable is it? Will somebody buy it without a guarantee? Obviously, it's going to restrict the amount of people that are interested in it, won't it, Dan?
No, it will do. It will do, and it comes down to, like as you say, resaleability, or even if let's say, similar sort of thing as potentially vulnerable clients. If you've got someone who is looking to raise finance in a nursing home, there's limited lenders out there that will do it because reputational risk and resaleability and repossession and such. So it's just about, again, weighing out the risk in terms of, is it a viable deal? And especially in the current market, because the market's so busy at the moment. I mean, the number of transactions that you guys are seeing is obviously overwhelming, and it's a record high. So realistically, do you want these sorts of cases at the moment? Unfortunately, a lot of lenders don't. When the market slows down, people may loosen their criteria and such to be able to accommodate these sorts of clients where, yeah, they might not have cover in place, or it's something that lenders want to look at. But as it stands, there's going to be limited lenders out there that can offer that product. Here's one for you. It fits nicely with another question that we've been asked as well, actually, prior to the event, which I've got. But if you provide a mortgage, whatever type of product, when the fixed rate expires with a pending SVR looming, will you be able to provide a new deal via a product transfer?
Fantastic and really well timed.
Exactly.
Exclusive on here, we've actually been piloting at the moment our retention deals. We've got some cracking retention deals, which if you have got any clients that are coming to the end of products, we are doing under the counter in head office at the moment. And the only reason that we're doing it that way, Dan, is because we're having to trial the process, and just to make sure that we can get the illustrations and that the process is okay. So we've only been doing it reactively, but we are about to launch to the market. I mean, obviously you guys know about it as our partners, but we are about to launch it out to the market, and it will be with a very competitive prop fee as well.
I've got to ask that question. No, that's brilliant. That's brilliant, because I know a lot of brokers do obviously your product transfers as such. So if you're offering that now, amazing. Which comes on to the next question that's came in, actually. So that's retention took care of. Next one, you currently only lend in England and Wales. Do you have any appetite to lend in Scotland at all? Because I mean, for us personally, we've got a lot of brokers and we do a lot of business up in Scotland. However, the market is still quite thin north of the border as such. So do you have any appetite to expand up there?
Absolutely. We're going to do probably just over, probably about 1.2 billion in completions this year, Dan, which is virtually double what we did as a lender last year. And one of the strategies that we have got is to expand into Scotland. We were hoping to do that a lot sooner, but obviously COVID, well, we were hoping to do the retention products a lot sooner, but we were impacted on COVID as soon as we started that project, and the same is for Scotland. I would hope that we will be lending in Scotland by Q3 of this year. Okay. So we've got a project going on at the moment with Mark Whittier, and he's looking at, you know, sort of all the ramifications, because obviously there's a lot of extra costs, as you'd know more than I would. Mind you, I did work for a lender that launched in Scotland, but you'd know a lot more than I would do about, you know, the extra costs that obviously as a lender that you incur through doing business in Scotland for a number of reasons. But yeah, we are going to be.
Amazing. Well, that's exciting news then. So again, keep us posted on that. Just one more question that's came in, so please do keep typing your questions if you do have them. Someone just said there, we constantly get emails around the Beat the Quote service from Crystal in relation to bridging finance. Can you elaborate that a little bit, Dan? Yes, so by that we mean any non-regulated bridging finance quotes you send to Crystal, we will always beat. We've never been beaten on bridging. So whenever you send me a quote and it's got a rate of X or a probability of Y or a term of Z, and you tell me what you want beating, as long as I've got a legitimate comparison, and I mean legitimate, so not terms that are being made up or let's say modified as such, then we'll always beat it, whether we're using our relationships with certain lenders as such or the exclusivity we've got access to. As long as I've got a legitimate terms to beat, then we'll always beat it. We've never been beaten on bridging finance, so bear that in mind, but that's a good question. Anything else that's came in? No, I think that is it for questions at this moment in time. Paul, do you have anything else you want to add before I wrap this up?
No, I'd just like to thank you guys. You know, you're really supportive towards us. You bring us deals with, you know, rationale, and it just makes our jobs a lot easier because, you know, you're always so prepared. And just to reinforce what Chris says at the start of the presentation regarding packaging, whoever you're packaging for, you know, if you're sending stuff to Crystal, if you can send it to Crystal in one hit, they can look at it, present it to the underwriter, and Keith will be able to help those people a lot quicker. But thank you so much for the invitation today. And I hope that Crystal and Foundation can help all you lovely people moving into the future. Thanks again.
No problem. Thank you very much, Paula. Thank you very much for your presentation and insight. It was fantastic and invaluable, as I'm sure everyone will agree. Please, if you do have any questions, any cases, as Paula mentioned, send them to ourselves. Chris mentioned at the very beginning that we do it on the basis of a package route where you have the control of the client, or a referral route subject to your network, allowing it as such where we can deal with that client and take on the ownership and advice. But more than anything, just ask the question, because again, you've learned through this session that anything's achievable. Foundation have got a great criteria, great product mix, and they've got a can-do and a yes attitude, so to speak, and that goes a long way, hence why they're on this webinar with ourselves. We only let certain partners come on with us, partners that do business, partners that we enjoy doing business with, and have great reputations within the marketplace. So after today, you'll get your CPD, you'll get the contact details to submit an inquiry or pick up the phone to ourselves. But please do ask any questions. That's it from all of us today. So thank you again for joining. Have a great day, and hopefully we will speak to you soon. Thank you. See you soon, Paula.
Bye. Take care.